If you ever wondered, how are people trading options and making the really big money? What is the secret behind the industry? And how can you, as a beginner, take advantage of the massive leverage that options gives you without being a professional, without spending years looking at charts, and doing it while you have a full-time job? This is the video that's going to break down for you step by step. The first thing you need to understand here is when it comes to options trading, there are three different strategies you need to know and think about. The first one is that you can be a scalper. There's somebody who spends minutes in the market and each trade usually averages 20 minutes or less. As somebody who day trades and has taught over 3,500 students how to do this, this is one of the fastest way to make money, but is also the most stressful and also the most time consuming. And what I've realized is that all the big influencers, all the big gurus, what you're starting to see left and right is that they're starting to quit day trades, focusing now more on strategies that are less time consuming. For example, there was a lady I was listening to yesterday that said after training and selling over 2,500 students, she's shutting down her day trading community, focus more on the long-term passive cash flow. And this is the power I'm giving you in this video. You want to pay attention. The first type of trader is somebody who scalps. Your trades are usually 20 minutes or less. When I do this, my average time in a trade is usually 3 minutes and 45 seconds, which is surprising. But that's how quickly you can make money. But you need to be like a surgeon. That's why it's called scalping. It derives from a surgical tool called a scalpel that they use to cut with precision to get rid of either tissue or things that are in the way of them doing operations. Just like a surgeon, that's how a scalper is. And just like a surgeon needs 4 years of college, 4 years of post-grad, and maybe another 3 years of mentorship, it's going to take you time to master this skill. With a mentor, yes, it might not take you 8 years. You can realistically do it in about 2. But again, you're going to spend 2 years learning the skill that's going to take a lot of your time and effort. If you already put the time in, or you already have 2, 3, 4 years in, maybe it makes sense for you to keep going. But as an absolute beginner, this is not what I recommend. The second type of trader is what I call a day trader. A day trader is somebody who's usually trading from 20 minutes to 8 hours a day. That's how long the options market is usually open. If you're somebody who's not scalping, but you're holding positions longer, you're considered a day trader. While you're not having as much stress as the scalper, because you're not having to make 1, 2, 3 minute decisions, as a day trader, you're having to make decisions every 5, 10, 20, 30 minutes, an hour holding these trades. One of my students is very good at this. His average profitable trades, he's usually in those positions for, on average, 56 minutes to an hour and 20 minutes. So if you have time to dedicate to the market, then that is something that you will want to look into. The third type of trader is somebody that I call a swing trader. A swing trader is somebody who holds positions overnight or longer than a day. Now, this can be confusing because there are different instruments you can use in options that are considered swings. If you hold a position for a week, it's considered a swing. If you hold a position for 2 years, it's also considered a swing. So how do you know, or how do you classify your trade as a swing trader? Great question. I usually break this down into 3 groups. The first swing trader is somebody who holds positions from 1 month to about 4 months. So you're in short-term trades, trying to double your money in a couple of days. This is what me and my students do. This is what the trend snap system is all about. Matter of fact, I did a YouTube channel, a video on my YouTube channel about how I made $30,000 a month using this strategy. It's very profitable, not as highly volatile, but you're still having to keep an eye out on your positions day by day. But if you're somebody who's more risk averse or you want more time, then we go into the second group of swing traders, which I call skips. Somebody who holds skips are usually trading between 4 months and 6 months out. Usually between 4 to 6 months is usually your time frame, or about 4 months to 8 months. That's usually your time frame where you're holding skips. This provides you a mix between the profitability and the explosive growth of short-term contracts and the safety of long-term contracts. If you want to have a medium strategy, skips is where you want to be as a swing trader. But if you want maximum safety, with the most amount of upside possible, I would say leaps is where you want to be. Leaps is when your opponent positions usually a year or more out. So somewhere between 8 years to about 2 years, that's what I call a leap trader. You're still swinging because you're holding positions overnight, but you're holding these contracts for a year, 2 years, sometimes 2.5 years out. This is what I call bonded. This is what I call almost bonded positions because it's almost as good as holding the stock with the leverage and the multiplication of options contracts. For those who don't know or don't understand, the beautiful thing about options is that when you choose the right contracts, when you choose the right stock and the right direction, when the stock goes up 20%, usually your options contract will go up 100%. That means you're doubling your money and making 5 times the profit as somebody who holds the shares. Well, and that's with loops, by the way. That's not even with the short-term swings or the skips. With leaps, the same option. When the stock goes up 20%, your contract will literally double, going up 100% more. If you want to be an options trader as a beginner, you want maximum safety, you want maximum flexibility, and you want peace of mind, leaps is where I advise you to go. But how do you actually do this, and how do you position yourself for the best entry? Let's dive into it. There are 5 parts of an options contract you need to know about from a beginner's standpoint. The first part is the ticker. The ticker, let me make this darker here. The ticker is the stock you're going to trade, whether that's Apple, Google, Meta, whatever the case may be. That's what the ticker is. The next part, or number 2, is the actual strike price. At what price do you want to agree to take control of that contract? At what price do you want to agree or make the options contract on? Let's say Apple is the ticker, and then the ticker for Apple is AAPL, and the strike price is 260. Remember, the thing about the strike price you guys have to remember is that the strike price is different from the stock price. With an options contract, you're making a contract, you're making a bet between you and somebody else. Let's say the stock price of Apple right now is 230, and you want to make a directional bet, think it's going to head up. Because it's going to head up, you can't just say it's going to head up, just pay me as it goes up. You have to pick a price as your anchoring point. That anchoring point is called your strike price. You will say that you're going to do an Apple contract for a strike of 260. It can go past 260 and you'll still be good, but you need a price to anchor your options contract. The third thing is a directional instrument. The directional instrument, or what I will call DI, is what I either call calls or puts. If you think the stock is going to go up, you can buy a call. If you think it's going to go down, you can buy a put. But in this example, we're going to bet the Apple is going up. We're going to buy a options call contract. The fourth part of a contract is the premium. The premium is how much you're paying to enter that contract. The premium is the down payment that secures the contract between you and the third party. Let's say you're going to pay a $200 premium for this stock. And the fifth part of this is the expiration. Every contract needs an end date. You can't just have it open for infinity. Nobody is going to take you up on that contract. So let's say you want to have a contract that's elite 1 year out. These are the 5 parts of an options contract that you need to pay attention to: the ticker, the strike, the directional instrument, the premium, and the expiration date. And I told you that we actually manipulate our profits based on the expiration, because if we choose a longer expiration, we're going to get less percentage increase on the same stock move, but more safety and peace of mind. If we choose remember, we manipulate our profits based on the expiration. If we choose a longer expiration, that means that we're not going to get as much as the profit increase as we could, but we're going to get back more peace of mind and safety because we have a longer term horizon on that contract. Mind you, if we choose a shorter expiration, we might not get as much safety, but we're going to get a highly explosive increase in our options contract. For example, I'll put the screenshot here. My student actually made 460% on her money in 3 hours. Where else can you afford extra money in 3 hours except for the stock market and do it legally, or maybe the casino? But this wasn't gambling because we're placing very educated guesses and decisions. She just manipulated her profits by using an expiration date that was 1 month out. If she had done that same trade and she used an expiration date that was 1 year out, instead of making about 460%, she would have made maybe only 55% on her money. So you can see the difference in whether you're choosing a short-term expiration or a long-term expiration. The other part I want you guys to notice is this. When all these 5 P's comes together, they're what I call an options call out, which means if I'm trying to communicate to you what options to buy, these are the 5 ingredients it's going to have. Now, I'll show you guys the nitty gritty of this so you have an understanding. But when it comes to actually execution, it's a whole lot more simpler than that. I just want you to know what you're talking about when we talk about options contracts in itself. Now, that being said, there's one more thing you need to pay attention to and know is that in the world of options, everything happens with the number 100. Everything is multiplied by 100 because in one options contract, there's 100 option shares. So everything that you're seeing is usually multiplied by 100. So if they say the premium on the options chain is $2, what they really mean is $2 per share in that contract. And since there's 100 shares in that contract, for one contract, you're really going to be paying $200. Now that you understand the anatomy of the contract itself, let's actually talk about execution and real life use case. Remember, I told you guys that we want to prioritize safety in these trades. So what we do is that we usually buy leaps and skips. Remember, leaps are contracts that are about a year or plus out. Skips are contracts that are usually 6 months plus out. That's the determining factor. What you want to use is the quad 4 strategy. 4 times during the year, once in March, once in June, once in September, once in December, every single year is something called quad witching, where a bunch of stock futures, stock options, and other commodities actually rebalance, making them cheaper. And coincidentally, this usually, not all the time, but usually aligns with a pullback in the stock market. This is your time to buy. What you do in this situation is when these dips happen, these 4 times a year, you wait 3 to 10 business days and then you go and buy lips and skips. That's it. You don't think about it. You don't think too hard. You just buy it and then you sleep with peace of mind. That's why I'm advising that you're buying leaps with this specifically, but you can also do skips as well. The difference between skips and leaps is the price of the contract might be different. So for a skip, it might cost you $700, but on the same stock, on the same ticker, same strike price, same expiration date. If you do a leap on it, so be a different expiration date because it's a leap. But if you do a leap on it, instead of $700, it might cost you $1,300. The reason that premium is more expensive is because of the safety that's given because it's a leap. But even with the expense, you're still usually doubling your money with this strategy. Now that you understand the contracts you're buying and the expiration, now it's time to understand the actual stocks that you're buying when you do this. The most important thing is buying reputable companies that you want to own anyways. I usually like to stick with either ETFs. So just like they tell you to buy the S&P 500 as a stock or an index fund, like your VOO, your VTO, you can also buy options on these. You can buy options on the SPY, which stands for the S&P 500, the QQQ, which represents the top 100 stocks in the S&P 500. You have the Russell, which are 2,000 smaller companies. You also have the IWM. You also have the Dow. These are all ETFs you can buy leaps and skips on if you're trying to avoid single stock risk. But if you want a higher percentage on your money, what you want to do then is take the SPY and the top 500 companies in the S&P 500 and get a list of all those 500 companies. The top 20 by weight, if you Google S&P 500 by weight, I'll show you here. If you go and you Google S&P 500 by weight, it's going to pop up for you all the top 500 companies in the SPY, the S&P 500, by weight, by percentage of how much that stock is held in the S&P 500. So 7.21% of the S&P 500 is in NVIDIA shares. 6.33% by weight of the S&P 500 is in the Microsoft shares, and so on and so forth. So just look at the top 20, and that these are the companies you can buy skips and leaps on. And look at Palantir. Palantir is now one of the top 20. We've been trading these when it was at the bottom as one of the top 50. Let's say you want to diversify your holdings. You're going to diversify by industry. You're going to get one in the top 20 that's in the tech industry, one that's in the consumer industry, one that might be in the banking industry, one that might be in the industrial industry, and so on and so forth. That way you're still getting the diversification like you would get in the S&P 500, but you're exposing yourself to way more upside potential because you're in individual stocks. That's what I'll do, guys. I have a strategy on this called the Quad 4 strategy, where I break this down as a video and a step-by-step PDF. If you want that PDF and that training, just comment the word Quad 4 below, and I will respond and send it to you. The second thing I want you guys to do is check out the video that I go over on buying and selling options. I'm going to link that right here. I think it's completely helpful for you that you actually take your trading to the next level. Chat soon.